Now, how can we see what's inside that candle? And comes along the reason we are all gathered here today on Sunday for the market profile charts. Now, the profile is nothing more than a normal distribution of market data. I am now going to extract information from the market and organize it very much in the same manner that I did for the home in Park City. Be prepared, you are now going to see the market in a very different way. There. All right. There is a profile. And that will help you make your trading better. What do you think? If I showed you that and said that's going to make your trading easier now, and you'll see things that nobody sees, most people, when they take a look at that, they say, that's it, I like the candle much better. All right, how am I going to chart that? What does that really mean? And our job here today is to make sense of that, to show you the power of this valuable data. What does this really mean? And of course, if this looks like gibberish to me. The one thing I will point out to you immediately, which is very, very interesting, is the fact that when we take market data and begin to organize it, we see a normal distribution. Isn't that interesting? Just that fact alone, that we begin to see a normal distribution, just as we would if we gathered any other kind of data. Now, that little chart, what did you see on that chart? What was it made up of? Letters. Very good. Those letters are called TPOs. And so, I want you to start thinking of those letters a little bit differently. What's a TPO? It's a time price opportunity. So every time the market came to a particular price, it created an opportunity for people in the market. They could be buyers or they could be sellers. If a transaction takes place in the market, at that point in time, the market prints a letter and it becomes a piece of data. So we know for sure that these are points of activity. We don't know if they were selling or buying, but we do know that it was a point of activity. So the TPO is the basic unit. Every time a trade occurs at a price during a specified period of time, the profile chart will print a TPO at that price. It is the basic building block of the profile, and we will learn how to use that. Now, the next piece of terminology that I'd like you to become acquainted with is a period. Now, these TPOs don't occur in a vacuum. They don't just happen at random. They occur during specific points in time. The profile I showed you a little bit earlier, that medley of letters, was a profile for a full day. So it was made up of a number of different periods. The standard period on a profile chart, and notice the word I'm using here, standard period, is 30 minutes. So your standard profile chart looks at the day and breaks it up into 30-minute intervals. Now, is anyone curious why 30 minutes? Thank you. As a matter of fact, anyone that is going to trade should always be very, very curious. You want to know and you want to understand why things are happening or why things occur the way that they do. The more knowledge that you have as a trader, the more information, the more powerful you will become as a trader. Never hesitate to ask questions. Questions are the way that you are going to learn. The more you are going to ask, the more you are going to learn, especially about the market. It is an open sea of knowledge and there is a lot to be learned. So never hesitate to ask a question. Now, I'm going to take my own advice and I'm going to ask you, why 30 minutes? In designing the profile originally, they toiled over what a period, the unit of a period should be in the profile chart. And so I will share with you what the designers thought and how they came up with 30 minutes. So at least you would know the logic. And then once you understand that, you begin to appreciate also the fact that I can deviate from that, and there are times when my profile will change based on the nature of the instrument that I trade. But let's talk about the 30 minutes. Human nature and human behavior shows that people tend to organize their lives in either hourly or half-hour increments. If you ask someone, what time do you get up in the morning? Rarely will someone say to you, I get up at 7:08. You know, they'll say I get up at 7, 7:30, sometimes maybe 7:15, but the most common answer is usually somewhere on the hour or the half hour. And since it is humans that are participating in the market, and their decisions are going to be based or made in the same way that humans tend to make decisions in general, they felt that the 30-minute increment was the minimal logical unit for the profile. So that's part of what the designers thought. And again, I want to emphasize, because this becomes very important in looking at different profiles for different instruments. The basic profile is based on 30 minutes. So here, is anybody able to detect what the final letter on that profile is? X. X is the last letter. A is the first letter, and W is the last one. Now, since this is the ES Mini, this is a 24-hour market. And notice sort of the structure, how much after the full day, a 24-hour period, we end up with almost a perfect normal distribution. That is not by chance, that is not random, that is the order in the market. All right, each period, A through X, represents a 30-minute time frame. So now you're seeing the cumulative result of all the data for a 24-hour period for every one of those 30 minutes scrunched together in a cluster. That's how we come up with the profile. Now, why didn't they just call it a normal distribution? Because that's what it is, the daily normal distribution. Well, because it didn't sound sexy. And they wanted a name they could trademark. So that's where they came up with market profile. They wanted an elegant name for it. All right, now we're going to begin into the nuts and bolts of the profile. I want you to be able to identify the key elements of the profile. First and foremost, where is the open? Do you see these little circles? Right here is the open for the day. Of course, A is the first period, and every time you see a circle, that indicates the open of a period. So now, let's see if we can identify where period B opened. Oh, not here, but how about here? Do you see the little circle there for period B? Okay, it is right next to the letter J, AOJ. It's a little O. So O, the letter O, identifies the opens for each period. Now, if I were to say to you, well, then where's the close for period A? It's the same point. Where B opened, of course, naturally, A closed. So that's how we identify where one period begins and the next one ends. Now, let's go on and take a look at the close of period A. Hopefully on this slide, it's a little more visible since I didn't put a highlight smudge on it. And now, I want to do a quick comparison before your eyes, and I'm going to show you what the candlestick for that same 24-hour period looked like. So if you were looking at the candlestick, this is what you would have seen. And if you're looking at the profile, this is what you would see. Now, so far, we haven't been able to make sense. We haven't detected anything earth-shattering. The one thing that I will submit to you that you probably could identify is you have more data. All right? So we have more data. The key question now is, what does that market data tell us, and how do we use that data? We know we have more. And somebody that was trading earlier told me that as long as he gets more value, there's more stuff, he's happy. So there's the more for you. All right, the first thing that we want to do is we want to begin to organize our data and break up the profile into important facts, things that can be useful for us in making trading decisions. And the very first thing I want to identify for you is what we call the value area. If you remember from our normal distribution, this is the area where 70% of the activity took place during that particular candle, during that 24-hour period. 70% of my activity, 70% of my activity right here. Okay? There's the value area high, and there's my value area low. Does that give me any more valuable information than the candle did? Okay. Well, a little bit more, yes, but we still don't know how to use that. All right. In order to be able to use that, we need to examine again this idea of a normal distribution and how that helps us. Well, take a look again at a plot of the market activity, and we have a mean. Does anybody remember what the mean is?
Most common price.
Very good, most common price. Let's translate that for us in trading terms. That is the price where the greatest amount of trading took place. Okay, now by definition, I would submit to you that if you knew where that price was, whether you bought long or short at that price, you should have still been able to make some money just on probability and statistics. A tick above it, a tick below it, but if you were right around the mean, you done good. for a small amount of profit. And by the way, the high frequency algorithms, that is their first objective, to try to identify where that mean is so they could begin rotating around it real quick, because that's the high probability of them making money, and two, greatest liquidity. And as a matter of fact, very often they create that mean. Okay? So I don't want to hang my hat too much on the mean, because it could just be back and forth activity, and we need a little bit more information. But before we deviate too far, let's talk a little bit about the concept of standard deviation. Okay. What is a standard deviation? It's a measurement of how far something is away from that average. If we are one standard deviation away, we start to get into an area away from the action. So if logic held true always, as prices started to go up above value, away from the mean, let's say 2 standard deviations, there is a greater likelihood that in fact this would be a good time to short and prices will come to the mean. That is true in a rotational market. But in an uptrend, they could continue to go higher. So don't make that mistake, because sometimes people make that faulty thinking and use it across the board. If you are in a rotational market and you identify a rotational day, you can make a ton of money that way. Sell above value, and then when it drops back below value, buy it again, and take the rotation up, rotation down, and keep doing that all day. And the further away you are from the mean, the greater the likelihood that you will come back to the mean. Remember that 68% rule. So we have a value area low and a value area high. What is very, very important for us is to take a look at the end of the session. And again, this is something that no candle will ever show you. Where is the close? Is it above value, within value, or below value? Does anybody remember the symbol for the close on the profile? Remember the open, it was the little circle. Did I highlight the close or I didn't mention the close? I didn't mention the close. Now is the time to mention the close. The close is right here. Do you see the little asterisk? That is the close on a profile. You see the asterisk. All right, now we're getting into some of the nitty-gritty of the profile and where the profile starts to show its power. Did we close below value, above value, or within value? Below value. All right. Okay, if I come to you and say, okay, 68% of what happened during that 24-hour period, all this activity here, all that, oops, not below here, but all this stuff here in the 68% area, and then we ended up closing below value. Was that selling or was that buying? Exactly, that's exactly right. It is very easy for me now to be able to understand what the market is telling me. The market activity up in that cluster within value, and I close below it, that was a lot of selling. All right. Now, if we go back to the bar that we looked at earlier, that candle, was it a green or was it a green or a red candle? Green. It was a green candle, wasn't it? Okay. So in some ways, the profile now has told me something that's contradictory to what the candle told me. Which would you be willing to trust?
The candle, because I know it.
All right. Well, and I appreciate that answer very much. The answer was the candle because I know it. The data from the profile is far more powerful than the candle, and this is why I'm here to get you acquainted with the profile and get you to know the profile. And the more you get to know the profile, the more you are going to let go of the candle and use the profile, and the candle just becomes sort of the corollary or the supplementary tool. So I'm getting you to switch friends here. This is why I like to highlight the differences, to begin to show you what is it that this profile can show me that a candle will not. So even though that candle was green, the pressure inside that candle really was negative. And the software also will draw the value area high and the value area low for you. Okay. So now we're going to switch gears a little bit, and I'm going to show two other levels from the profile. If you take a look at the profile, if you notice, I have a magenta line here and another magenta line above it, and I have a value area line here and a value area line there. Now, we decided, or we agreed on in terms of terminology, the green lines were my value area high and my value area low. That's based on price. Now, let's take a look at volume, the volume profile. And if you take a look right next to my price profile, there is sort of a green or a light blue profile. I don't know if you can everyone see that light blue shadow in front of this other profile. This is like a bar chart, very good. This is a volume profile. So the one on the left is the time price opportunity. Every time we ticked and a trade took place, I had a letter. On the other side, it's showing me the normal distribution of actual volume. And this is very, very important because the volume profile is far more important than the price profile. Now remember when I told you that often you will get a lot of high frequency trading in a particular area? Take a look at the top magenta line and then the top green line. And take a look on the profile, the volume profile. Do you see any big bars? They're all very skinny bars. What does that tell us? Look at the cluster, how much activity we had there. Where's the volume? Well, what's the significance of that? When I have volume below, when I have volume, the volume profile at the bottom end of the full profile. Volume will always move in the direction of where the market is going. So now, I have very skinny volume at the top, but a lot of fat activity. Where is the market facilitating trade? To the downside. And notice my volume profile is below my price profile. Most of the time, the two will be balanced. I have an imbalance here. A lot of activity at the top, but volume is really down here. In other words, and now notice, we never try to predict what the market will do, and I'm not going to predict for you, but I'm going to tell you that there is a high probability, a great likelihood that prices will probably continue to drop. Volume is facilitating trade lower, not to the upside, to the downside. We closed below the value area low, and my volume profile is below my price profile. So now I have a high probability setup for a short. I'd love to see you show me a candle that'll show me this. The candle hasn't been invented yet. All right, there's the beginnings of why the profile is so powerful. Again, take a look at the entire volume profile that we talked about, and take a look at the value area for that profile and how it is different from the value area for the price profile.